All right, welcome back. It's been a little bit since I've done a video, but I was trying to find, some good content that I wanted to put out there. And with everything that's been going on with interest rates recently and the economy, taxes, the election, I thought this would be a good conversation to have today. So what is premium financed life insurance? If you're affluent, if you're high net worth, you may have heard of this from other people in your circles. You may have heard of it from your financial advisor. You may have heard of it from your CFO of your company. But life insurance as a whole can provide a very attractive tool that can provide financial protection and accumulation benefits, such as an income tax-free death benefit, tax-deferred cash value growth, which I've done some videos on the tax-deferred nature of the cash value buildup, tax-free access to that cash value if structured properly via loans and withdrawals. I've done videos on that. Going to do another video on a third-party article that just came out recently about how to use your life insurance policy, the cash value as a collateral play to get a loan from a financial institution. I'll get into that later. And life insurance can also provide creditor protection, depending on the ownership and state of issue. However, to fund that life insurance policy, it may require lucrative assets be liquidated or cash flow be directed to fund those premiums, which many of our clients, my clients, find unattractive. What if I told you there was a way that you could have all of those things, the tax-free death benefit, the tax-deferred cash value growth, the tax-free access to the cash value, all without having to pay those premiums? Make sure you like, comment, share, subscribe. Let's dig into what premium finance life insurance is, the good, the bad, the ugly, and let's talk about it. Premium financing can be an alternative method to funding life insurance premiums that involves borrowing the amounts needed from a commercial or institutional lender, as opposed to paying them out of pocket. And the initial cost then becomes only the loan interest, which can be paid in cash or it can be accrued in some instances. And then the loan is collateralized primarily by the policy's cash value, with any shortfall being pledged by personal assets. And there's different types of assets that can be used, from cash equivalents, marketable securities, land, real estate, commercial properties. And then there's other things, which if you're my client and my prospective client, I'll tell you about. But here, that's why you need to, in the description section, make sure you reach out and let's schedule a 15-minute phone call to discuss this. What are the benefits? The benefits are paying loan interest or pledging collateral instead of paying the premiums can significantly, substantially, almost entirely reduce the cost of the strategy or leverage it for more efficient results, such as an increased rate of return on the cash value. And there's 4 different arbitrages that life insurance premium financing can have, which I'll do a different video on that. But real quickly, the 4 arbitrages are: 1, if you're not paying the premiums, you're not having to pay tax on the income to pay those premiums. Arbitrage number 1. Arbitrage number 2 is the fact that you can probably earn a better rate of return on your money, leaving it in your investments, leaving it back in your enterprise, as opposed to the cost of borrowing the money from the financial institution. That's arbitrage number 2. Arbitrage number 3 is the internal buildup of the cash value historically in these policies has been greater over the long-term average than the cost of borrowing the money from the banks. Now, in any one given year, that may not be the case, but over a 10, 15, 20-year window, which is what we're talking about, this is a long-term product or long-term structure design, we need the arbitrage, the cash value crediting to be greater than the cost of borrowing those funds. And those are what the naysayers would say, is that over the long term, that's not the case. Well, I would argue differently, because it's a fundamental belief in capitalism. Our country's built on low interest rates, high capital appreciation in either equity indexes, small business enterprises, things like that. You're going to earn more money by promoting business and capitalism, which is where the stock markets get their growth from, compared to interest rates and borrowing rates. So that's number 3. Number 4, the other arbitrage is the death benefit is always income tax free, right? So there's some really good arbitrages at play. Additionally, when you're financing the premiums, the need to liquidate or redirect cash flow from those lucrative investments can be reduced or completely eliminated, and which would mitigate the transaction costs such as capital gains taxes, income taxes, things like that. And lastly, securing life insurance while keeping capital deployed towards your existing investments or retained assets can help preserve and grow wealth and reduce the opportunity cost, assuming the rate of return on these investments or the retained assets exceeds the cost of borrowing, which is one of those arbitrages that I just talked about with you. But what are the considerations, right? It's not just good. There's some considerations that you have to think about. One is interest rate risk. If borrowing costs rise to a greater extent than originally projected, it could result in more out-of-pocket costs or more collateral to be pledged, right? And really it's about more collateral to be pledged. And that's why these designs, when you're going through them, they need to be properly stressed and structured to make sure that you don't have any surprises down the road that you weren't already expecting. Second consideration is performance risk. The cash value can fluctuate, and it could be less than originally projected based on the timing of when you're looking at the snapshot of the structure, which may result in more additional collateral needing to be pledged. Could result in less net death benefit or a shortfall of cash value to repay the loan. Again, things that you need to look at. The exit strategy. There should be a plan in place for the exit strategy for the loan, whether that's using the existing cash value of the policy at a time in the future, whether it's a sale of an outside asset to pay off the bank loan, or whether it's a different type of loan refinancing that needs to happen. But you definitely need to think about an exit strategy, or you're presenting this to you need to think about an exit. While I'm about to sneeze, take this opportunity to like, comment, share, and subscribe. Okay, I think it passed. And then the other consideration, which is the one I keep coming back to, and I'll point out here in a second, is the collateral risk. If the loan defaults, in other words, if for whatever reason the bank needs to call the loan because of the client's inability or lack of desire to pledge the amount of collateral needed, then the collateral that had been previously pledged will be consumed by the lender, because that's what lenders do, right? Lenders loan money not because they're nice institutions and nice people, but they loan money because they want interest and they want collateral. And if you don't pay the loan, they close the loan, they take the collateral. Everyone knows how loans work. So while that's a risk, it's a common sense risk. And so that's why this structure needs to be understood, and it needs to be done properly within suitability, within affordability guidelines. And so this would be kind of a structure or a model of what the design would possibly look like. So you have the grantor, the business owner, the ultra high net worth individual, the affluent person that wants to take out the policy. And so we're gonna then set up a single purpose LLC or a trust, insurance trust, either irrevocable or grantor, that is going to hold the policy, hold the loan. We're then going to go to a commercial lender, institutional lender, borrow the funds to pay the premium. Once the lender knows that what the cash value of the policy is going to be, once they know what the interest rate is going to be, once they know what the additional collateral pledge, the premium is lent, the policy's funded, it's enforced, there's beneficiaries, there's owners, and we're into the design. Now, that's super high level. Let me go into a design on what this would possibly look like. And I'm going to compare premium finance to term insurance, indexed universal life, self-pay, whole life, self-pay, variable life, self-pay. And we're going to do this from a pure death benefit discussion. And then I'm going to show you an income, a tax-free distribution play. But let's start with this. So from a $20 million policy, let's say I've got a 45-year-old male, preferred plus, non-smoker, $20 million policy. What we're talking about here is if we're going to do a 10-year term insurance policy, it would be $10,000, almost $10,000 a year, $9,390, but $10,000 a year for 10 years, right? For a $20 million policy term. 20-year term goes up to nearly $20,000 a year. And then 30-year term goes up to nearly $30,000 a year. And I already did a video on this. You can watch it right here. But I did a video that talked about how less than 2%, depending on your source, less than 1% of all term insurance policies ever written since the history of insurance, less than 2% has ever paid a death claim, period. which means 98 or 99% of all term insurance policies either expire without a death occurring during that 10, 20, or 30-year window, or the insured cancels the policy because they no longer need it. And so all that money's gone. All those premiums that are paid are gone to the life insurance carrier, not to you. And that's why people saying that you need to buy a 15-year term at this amount, like Dave Ramsey, Susie Orman, they don't know what they're talking about. They really do not know what they're talking about. Indexed universal life, right? So whole life, variable life. So these are self-pay options right here. And I'm going to blow this up as much as I can. So if we have different carriers that are offering a $20 million policy to a 45-year-old super preferred non-smoker on the indexed universal life insurance chassis, the cheapest one we could find to fund it for 14 years is $177,000 a year. Cheapest, 170, to make sure that the policy is still going by age 90 and has a death benefit at age 90. Now, think about that, $177,000 a year, and remember some of the considerations and the benefits that I talked about, some of the arbitrages. You have to have earned money, paid the tax to have $177,000 available to pay that for 14 years. If we're in a 50% tax bracket, just to keep it simple, that's $340,000 a year of income to pay the tax, to pay the premium. Would it not be better to potentially borrow the premium? Anyways, I digress. We'll go to variable life. Variable life has more volatility to it. It doesn't have a fixed component, but there are some places for variable life. $157,000 a year for a 20-year term, or for a 14-year premium duration window, $157,000 a year. And then we've got whole life. Whole life is expecting a lot more. It's got lower rates. It's got guarantees to it. I will give you that, but it's got lower rates, but you pay for those guarantees. And in this example, for this carrier, for a premium duration of 14 years, in order for it to function the way it needs to function, in comparison, $700,000 a year is the premium payment for 14 years consecutive. But then we've got premium finance from a death benefit perspective, and then we've got it from a tax-free income perspective, or a tax-free distribution. If we're strictly looking at it from a death benefit perspective, and we have run various designs, seeing what we can get this to look like, in this one particular carrier, we're going to show $76,000 a year as a loan payment, as a partial loan payment for 14 years. And at age 90, $76,000 a year is cheaper than the variable life. $76,000 a year for 15 years is cheaper, for 14 years, is cheaper than, much cheaper, 10% of the cost of whole life, and then much cheaper than the IUL self-pay option. So $76,000 a year. Now, what's the trade-off? Because remember, we're borrowing the money. The trade-off is this person who's typically going to be affluent, successful, high net worth business owner, entrepreneur, athlete, entertainer, they have assets that they can pledge as collateral, where others may not. So the peak collateral pledge for this projection is $1.1 million. But collateral pledge is just that. It's a pledge, not a fee, not an expense, not a cash flow. So to the extent somebody has it, they may want to do that, right? And here's what the design would possibly look like, right? So for a 45-year-old male, we've got a premium of $1.5 million a year for 7 years to properly fund this design. But again, we're financing those premiums. We're borrowing those premiums. We're not paying it. The client here in column 12, $76,000 a year for 14 years. That's what the client's paying out of pocket. They are also pledging gap collateral, because what the lender who's loaning the $1.5 million a year is they're taking the cash surrender value, the liquidity number of the cash value of the policy that they can put a lien on, and they're then subtracting that number from the loan balance from whatever the client pays out of pocket, and that's the collateral pledge. But if you were this client, you were affluent, you were 45 years old, and you had the ability to cash flow $76,000 a year for 14 years, cheaper than the self-pay options, permanent, and you had the wherewithal and the ability to pledge collateral of $1.1 million, and we show, 15 years from now, the loan being exited, you would have paid $1 million in this example over 14 years, and you would still have in 15 years, a nearly $25 million death benefit for your family. That's an IRR of 34%. Where else can you get that IRR? Not to mention, as we push this out even further to age 80, it's a 13% tax-free IRR. Think about that. But this is a 45-year-old. Maybe the 45-year-old isn't so much excited about the death benefit only. Maybe they're interested in the potential of tax-free distributions. Well, same design, same death benefit, same out-of-pocket payment, same collateral pledge in column 14. Instead of just being a death benefit only play, we asked for the software to solve for a tax-free distribution amount in $706,000 a year. Income tax-free distributions is what this individual would be able to take in this projection through their age 120. I think we go all the way through age 120 in this. Yeah, 117. Think about that. They're paying $76,000 a year for 14 years. That's $1 million that they've paid. By the end of year one, in the middle of year two, they would have recouped all of their payments that they would have made, and every other dollar thereafter, they would have been living off of tax-free money that they basically created out of thin air. Think about that. It is an amazing opportunity to create tax-free distributions when you properly apply leverage to your structure. This is not for everybody. It's not without risk. It's not without things to consider. But the benefits for those that do qualify, that have collateral capacity, that have the ability to pay some interest out of pocket, that are insurable, those types of prospective clients, this is absolutely something you need to think about, whether it's income play, and who would not be interested in that type of tax-free distribution when you're only paying $76,000 a year, as well as the death benefit play. But remember, let's consider the risk: interest rate risk, performance risk, exit strategy, collateral. Let's think about that. Let's put a structure in place. Let's talk about this, because there's no perfect investment. There's no perfect savings account. There's no perfect loan structure. We can customize this for you to make it work. Like, comment, share, subscribe. Click in the description section, 15-minute. Let's have a phone call. Let's talk about it. I promise you, you will come out of it more knowledgeable than when you went in. See you in the next video.